Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. I hope you're all enjoying your weekend. The 20th Party Congress concludes today. Then tomorrow, Sunday, after the convening of the first plenum of the 20th Central Committee, we will learn who the new Politburo Standing Committee, the supreme leadership of the country, will be. Because this is such an important development, we may have a special Sunday episode tomorrow discussing the lineup. Otherwise, I will let you enjoy your Sunday and we will be back with regular videos on Monday. First up for today's video though, let's talk about Hong Kong. The Special Administrative Region has had a tough few years, with protests, pandemic, political clampdowns and lockdowns. And now, the bruises are really beginning to show. Let's discuss the economic condition of Hong Kong, and first up, the positives. We remember that Hong Kong dropped its 3-day hotel quarantine rule for inbound travellers on the 26th of September. With this easing of inbound travel restrictions, official data show a surge in passengers travelling to Hong Kong, and travel-related companies are finally expanding their workforce. At an Airport Authority Hong Kong job fair last weekend, for example, 18 companies sought manpower to fill as many as 1,200 jobs. While the trend is more positive now, it is coming from a very low base. Hong Kong's flagship carrier, Cathay Pacific, recently announced that it hopes to restore passenger capacity to just 25% of pre-pandemic levels by the end of this year. Meanwhile, this week, Chief Executive John Lee gave his first policy address. During the address, Lee unveiled an ambitious blueprint promising, quote, to go all out to attract talent and enterprises, build more affordable homes, improve healthcare, reform the governing system, and seize development opportunities, end quote. The plan will increase Hong Kong's public housing supply by 25%, with an aim, too, to shorten waiting times to 4.5 years within the next 4 years. As of June 2022, applicants have to wait an average of 6 years to move into public housing units, according to publicly available official information. Hong Kong's new leader made sure that his comments were politically correct also, from Beijing's point of view, expressing, quote, with an intricate and volatile international political environment, certain external forces have been deliberately smearing our country and distorting the situation in Hong Kong. End quote. Pressure has been on Hong Kong leadership to reverse the exodus of expats and businesses, but markets were overall unimpressed with Lee's comments this week. The Hang Seng Index closed 2.4% lower on Wednesday after the address, flirting with its lowest point since the global financial crisis. A sub-index of property developers dropped 1.8% to the lowest level since 2011. To be fair to Mr. Lee, delayed economic data releases from China, the nation's pledge to stick to zero COVID, as well as new language announced at the 20th Party Congress this week, critical of wealth accumulation, are also factors behind the terrible stock performance in Hong Kong and of Chinese stocks generally this week. The Hang Seng Index is now trading at 0.7 times its book value, the cheapest ever. Yet, tellingly, investors remain hesitant. Quote, although Hong Kong stocks are at low levels and their valuations are low, the overall tone of the market is still cautious about a global recession, and investors are also waiting to see when the overseas markets will stabilize. End quote. We remember too this week in the United States, the Nasdaq Golden Dragon China Index saw a one-day drop of 7.1%, hitting its lowest point since 2013. While we note that many stock markets around the world are also performing poorly this year, Chinese stocks traded in Hong Kong and the US have done especially poorly. Redmond Wong, a market strategist at Saxo Capital Markets, put investor anxiety succinctly when he observed this week, quote, extended weakness in China markets is due to slower economic growth, both cyclically and structurally. End quote. Speaking of structural decline, we will be discussing the housing crisis later in today's video. Meanwhile, while we are still on Hong Kong, the city's consumer inflation rate jumped in September to the highest level in 7 years too. Data from the Census and Statistics Department, published yesterday, Friday, show that Hong Kong's composite consumer price index climbed 4.4% last month, year on year, modestly above expectations. Prices for food, clothing, and energy-related items rose, which is largely what consumers in parts of Europe and North America have also seen in recent months. While the inflation is high, especially by Hong Kong standards, relative to other developed economies currently this year, it's on the more modest side of high, and should be manageable for the Special Administrative Region. Next up, let's move to the mainland. Hey guys, hope you're enjoying the weekend, and I hope you're enjoying today's episode of China Update. If you do, don't forget to hit that like button. And for anyone who wants to go the extra mile and help me continue making these episodes for you guys every day, if you like what I'm doing here with China Update and you would like to help me keep the channel sustainable, it's just me making these episodes, Patreon and Buy Me a Coffee links are in the description below. This is a massive help to support the channel, and of course those of you who support the channel are thanked in every episode, as you can see. As always, thank you so much everybody for the ongoing support. Xi'an, provincial capital of Shanxi province, famous for its terracotta warriors, is now looking at a potential third citywide lockdown since the start of the pandemic. This week, local authorities locked down parts of the metropolis, telling some of the city's 13 million people to stay at home for at least 1 week. While the entire city won't be shut down yet, some areas deemed to be of high and medium risk for the virus will be locked down, according to an announcement on Thursday evening by local authorities. As of yesterday morning, the city had 57 high-risk areas and 74 medium-risk areas. This number climbed further on Friday. Residents in high-risk areas need to stay at home until no new COVID infections are reported for 7 days straight, and they get downgraded to medium risk, in which there are still restrictions. The lockdowns were announced after the city discovered a few dozen COVID cases this week. As we saw with yesterday's video, other major cities, Zhengzhou, Beijing, Shanghai, and Shenzhen, are also implementing restrictions and targeted lockdowns this week, as China last week saw its biggest surge in cases in months. And Beijing leadership signals that zero COVID is likely here to stay still. Anhui's provincial capital, Hefei, also in response to a small spike in cases this week, on Thursday shut indoor facilities including cinemas, gyms, internet cafes and bars. Middle and primary schools have been closed too, and universities must operate in a so-called closed-loop management system. Next up, and finally for today's episode, let's touch on the housing crisis by covering yet more regulatory easing aimed at stabilizing the collapse in the housing market. Yesterday, Friday, we learned from multiple Chinese financial outlets that the China Securities Regulatory Commission is easing restrictions on certain real estate-related companies to raise funds from domestic stock sales. Chinese financial outlet Caixin writes today, citing sources, that the regulator will allow certain companies with small interests in the real estate business to sell shares, but the proceeds cannot be invested in the property business. Eligible companies will be those for which property-related businesses contribute less than 10% of profit in the past financial year, showing that while regulators want to stimulate the market wherever they can, they are still deeply concerned about systemic financial risk, which would be a far greater monster to wrestle than the ongoing Evergrande property crisis has been. This measure will, quote, mark a major shift in rules on property-related companies' financing activities since the China Securities Regulatory Commission barred all companies with interest in real estate from domestic share sales in 2018, including initial public offerings and additional share issuance, end quote, writes Caixin. In response to a shocking wave of defaults from developers and a collapse in housing sales, since May this year, governments at all levels, from Beijing to the local level, have passed a slew of measures to prop up the housing market, including cuts in down payments and mortgage rates. Data compiled by industry consultancy firm China Real Estate Information Corp show a total of 148 easing measures in 121 cities and provinces to support the property sector were rolled out in the third quarter of this year alone. These have mostly had little to modest effects, however, which is why we are seeing more aggressive easing now. Now, moving from the central government to the Chinese government at the local level, also this week, some Chinese cities have temporarily cut mortgage rates for first-time home buyers to below 4% after the country's central bank, the People's Bank of China, and the above-mentioned banking regulator gave them the green light in September. Interest rates on mortgages have already fallen 3 times this year as a result of 3 reductions in the 5-year plus national loan prime rate, LPR. These cities cutting rates include Hubei's provincial capital, Wuhan, the highly leveraged northern megacity of Tianjin, an hour or so from Beijing, the capital, and Guizhou's provincial capital in the southwest, Guiyang. Qingyuan in Guangdong province cut its rate to the lowest at 3.7% this week, below the official national floor of 4.1%. The temporary relaxation of the national mortgage rate floor will last until the end of this year, unless, of course, the People's Bank of China extends it further, which is a possibility. Analysts believe about 24 major cities can take advantage of the new policy from the central bank. While Beijing regulators had initially anticipated some instability and pain as they forced the housing development sector to engage in much-needed deleveraging, it appears that even they were shocked by just how extensive the downturn in the market has been, with the unintended fallout of mortgage boycotts with its accompanying threats to the wider financial system, especially inviting disquietude in the minds of Beijing policymakers. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a lovely weekend, and I will see you all tomorrow.